When you make an investment in any asset, whether it's a real estate asset or maybe farmland or really anything, the entire point of owning that particular investment is for that investment to generate profits for you in the future. That's pretty obvious. The not so obvious point, though, is how those investments generate profits on your behalf. A lot of times people buy an investment with the mindset that they're going to make money on it by selling it at some point in the future at a higher price. This is what's called the greater's fool theory, and that is that you're just banking on a greater fool coming along at some point in the future and paying more for the stock than you did, and that's not a particularly good way to make money in investing. It is certainly one way to make money on investing, but what we want to do is turn investing away from a speculative greater fool theory activity and turn it into a rational system that we know almost certainly, not certainly, but almost certainly, that so long as this underlying asset continues to generate profits on our behalf, that at some point it's going to also result in price increases. To illustrate this, we're going to pull up a stock in the DCMIQ platform. We're going to pull up Johnson & Johnson. And one of the things that we look at when we're evaluating a dividend growth company is what we call the dividend staircase. So the dividend staircase simply shows the indicated dividend, which is what the company has announced it is planning to pay for the next quarter, and we simply annualize that. So back in February of 2026, Johnson & Johnson had an indicated annual dividend of $3 per share, and the stock price was $105. So by purchasing the stock, one share at $105, you would get an annual income of $3 per year, which works out to just a little bit under $3, or excuse me, 3%. So let's say you continued to own that stock for the next 10 years. So let's fast forward now to February of 2026. Currently, the dividend per share is $5.20. So if we just quickly do the math on that, that works out to about a 73% increase in the amount of dividends per share that you're getting on the stock. And remember, you still have your one share that you paid $105 for. So now your shares are generating $5.20. So if we take that $5.20 dividend divided by what you paid for the stock, 105, that means that your annual return for just the dividends alone on the price you paid for the stock is now about 5%. Furthermore, you have new dividends that you were able to either spend or reinvest back into Johnson & Johnson shares or maybe some other stock. So throughout this time, you've started with a yield of about 3%, ended with a yield on cost of about 5%, and we haven't even talked about stock price. So one of our key beliefs at Donaldson Capital Management is that as the underlying cash flows of the business, in this case we're talking about dividends, cash flows that are being paid out to you as dividends, as those go up over time, the stock price naturally must follow along. Now, this doesn't always happen perfectly. Sometimes it doesn't happen at all. There are cases where a company can pay a dividend that's not supported by underlying cash flows or earnings. So those can be dangerous situations. However, if you have a company that's still supporting its dividend per share with earnings per share, cash flows per share, and the market believes has a reasonable possibility of continuing that in the future, we should see the price move along with it. And that's exactly what we saw with Johnson & Johnson. So you can see as the dividends per share increased, as represented by this blue line, the stock price, the red line, generally flowed along with it. That fell apart a little bit in 2022, 2023, and 2024 when you see that the stock price fell dramatically below the pace of the dividend growth. However, in about the last 6 or so months, that has been corrected pretty sharply. The stock moved from $152.75 in June of 2025, now up to a stock price of $227. So again, had you just bought your one share back here, collected your $3 dividend, Your dividends would have gone up 75%, and meanwhile, the stock price would have gone up approximately 116%. So, again, in this case, the stock price went up a little faster than the underlying dividend, but in general, the rising dividend tends to have a positive upward effect on the stock price. And in companies where those are very strongly related, we believe you have a really good opportunity to not only collect ongoing dividends that grow over time, but get predictable long-term price increases as well. If you would like more in-depth analysis and help with your own portfolio, we do offer a 1-hour consultation with one of our CFAs to do an in-depth portfolio analysis on your portfolio. We also have financial planning consultations. Both of those packages start around $500. We also offer comprehensive financial planning. You can sign up for that for a year at a time, or if you're interested in having ongoing investment management, we offer those services as well. So feel free to reach out to us if you have any interest in that. Thanks for watching, and we'll see you in the next video.